Good afternoon. It's a pleasure to be back here at the conference. Alistair, thank you for the invitation. I've been here at each one of these conferences since the first year onward. First time to present, so I feel a bit like I'm calling into a radio station. Hi, I'm Chris, longtime listener, first time caller. Glad to be here. So today I want to talk to you more about the announced merger between Era and Bristow, which we announced about a month ago. This is an all-stock transaction that will be treated as a tax-free transaction, and we expect this merger to close by the second half of this year. The transaction will be effectuated by us issuing ERA shares to Bristow shareholders. Afterwards, Bristow will become a subsidiary of Era, and ERA shares will continue to trade on the New York Stock Exchange. We will rename the parent company Bristow and operate as Bristow on a global basis. After giving effect to the transaction, the current Bristow shareholders will own 77% of the pro forma company, and Era shareholders will own 23%. I've been asked to serve as president and CEO of the combined company, and I'm excited to talk to you more today about what that combined company will look like and what we see as the compelling strategic and financial rationale for the transaction. Read these 2 pages very quickly. Well done. So a few of the key financial highlights for the combination. I would note that each of the numbers on this page are annualized run rate numbers in US dollars. So we're expecting about $1.5 billion in annual revenues from the pro forma company and an adjusted EBITDA of $240 million. We get there by taking Era's current run rate EBITDA of roughly $40 million, plus Bristow's current EBITDA of approximately $165 million. And we'll talk more about how they got to that number through their financial restructuring. Add on what we've identified as at least $35 million of cost savings, and that totals the $240 million of annualized run rate EBITDA that I mentioned. After you deduct interest expense, maintenance, capital expenditures, and some cash taxes, we get to a run rate free cash flow of approximately $140 million on a run rate basis, which we believe presents a very robust free cash flow yield on the current size of the company. This page outlines, again, what we see as the compelling strategic and financial rationale for the merger. I'll walk through most of these points in the following slides. I would say, though, that on the onset, one of the main reasons we believe this combination works is that the two companies, Era and Bristow, do share a very strong cultural alignment, including the priority of safety as our number one core value and highest operational priority. And that is really foundational to what will make this a successful integration. So geographically, we see this combination as strengthening the global leader in the industry with significant presence in key areas. And that last part we view as being key. We're not necessarily saying that we're in every market or that we want to be in every market, but for the markets that we've identified as being attractive, we want to have scale in those markets. And we believe this combination of Era and Bristow is the best strategic fit in the Americas region. It affects consolidation in the U.S. Gulf of Mexico market, which is one of the largest in the region. Also presents a very nice complementary footprint in the balance of the hemisphere. From the business in Canada and Mexico to round out North America, of course, Brazil, Colombia, and South America, and then importantly, that triangle in the Caribbean region between Trinidad, Guyana, and Suriname, where the combined company will have a leadership position in each of those markets, all of which have been growing and relative bright spots even during the worst of the downturn over the last 5 years. From a fleet standpoint, we see this merger as combining two very complementary fleets. The combined company will be the largest global operator of each of the S-92, the AW139, and AW189 model helicopters, which we see as being the most in demand currently for deep water offshore oil and gas operations. From an ownership versus lease standpoint, we also see a healthy balance here with approximately 80% of the fleet being owned, the other 20% having attractive lease rates, and we look forward to continuing to have strong, constructive relationships with the lessors as part of the go-forward financing strategy for the combined company. From an in-market standpoint, of course, revenues are still mostly coming from offshore oil and gas. That represents about 75% of combined revenues. However, we believe there is good diversification from more stable government services contracts. On the Era side, that is an exclusive contract with the Bureau of Safety and Environmental Enforcement, which is a branch of the U.S. government. And then, of course, and very importantly, with the United Kingdom, as Bristow is the provider of helicopter services, as you well know from Russ's presentation earlier, and by reputation for the UK SAR contract. We have not disclosed the specific cash flow contribution from that contract, but I think it's safe to say that it's more significant than the revenue mix that's shown on this page. So we think that in-market diversification is important, adds some stability to the cash flows of the combined company. This page quickly highlights a lot of work that was done during the restructuring process that Bristow went through, which was really transformative for the company as part of their Chapter 11 process. And you can see here the bridge from their FY 2019 to the run rate EBITDA that I mentioned of 165 million. A number of things contributing to that as outlined on this EBITDA bridge that you see here. Most importantly are the rent savings that came through a combination of lease returns, lease rejections, buying in aircraft that were on lease that are now owned, and then importantly renegotiating some lease rates. That all translates into about a $70 million annualized benefit from lower rent savings, which is driving a lot of the cash flow improvement and adds to the benefit that was achieved by equitizing approximately $900 million of debt with the associated interest cost savings, and then also eliminating the order book that had existed prior to their Chapter 11 filing. So really, after this restructuring, it's strength coming together with strength from our view in terms of the financials of this combination. One of the main value drivers that I referenced earlier are the cost savings that we've identified, so at least $35 million of synergies that we see as part of this transaction. Most of these are fixed cost in nature, so we view them as being highly achievable. We think it'll take about 12 to 24 months to fully realize them. A lot of that timeline driven by the necessary process to integrate our operations in the U.S. under our FAA certificate, combine those certificates into one going forward. But really most of the dollars in that $35 million are coming from, on the one hand, the elimination of redundant corporate expenses, secondarily realizing those operational efficiencies that I mentioned in the U.S. Gulf of Mexico, and then third, optimization of the maintenance programs on the aircraft and the fleet utilization. Here again are some of the financial highlights as we see them of the transaction. We already talked about the upper left part of the page, which is the pro forma adjusted EBITDA of approximately $240 million on a run rate basis. You can see that's driving better margins contributed by the EBITDA, getting back up to about 16%, which is where Era is today, where we see the combined company going on a pro forma adjusted EBITDA margin basis. We believe the company will have a very strong combined balance sheet. Based upon FY 2019 numbers, that's about 2.5 times net leverage, getting to the run rate EBITDA number that goes down to around 2 times net leverage. So again, an area that we think is a strength. This also will have a large combined cash balance. In fact, we are fortunate in that we're able to effect this combination without any need for outside financing. In fact, when you put the two cash balances together, it's a little over $300 million. We'll pay down Bristow's 2019 term loan, and so the resultant pro forma cash balance after that debt pay down would be well over $250 million of cash at the time of the closing, which again, we think puts us in a position of strength financially. The company's well positioned to generate free cash flow going forward, so that leverage picture should only continue to improve over time. Finally, I want to note that we see the combination of having benefits to all of our stakeholders. We see a number of benefits for the customer base. The combined company will have a larger fleet, a global fleet. We'll be able to deliver more flexible fleet solutions to the customers wherever they are in the world, whatever the optimal mix of aircraft models is for them. Also, given the financial strength that we've spent some time talking about today, the combined company will be very well positioned to continue to invest in new technology and safety features and to replenish the fleet on a go-forward basis. We also think our employees will benefit from the overlap and strong cultural alignment, plus the additional opportunities that will be available in a larger global organization. I've talked a lot about the value creative benefits for shareholders, which we view as being very important. And then for lenders as well, we see them benefiting from the stronger nature, the larger, more diverse nature of the company on a go-forward basis. So we're very excited about the future of the combination and happy to take any questions.
Do we have any questions? You've obviously answered. Yeah.
To what extent will Era still be involved in leasing, or are some of the savings to be made by the combination of Bristow's taking on those leases effectively, once you merge the two organisations?
Just to make sure I'm answering the right question, to what extent will the combined company continue to lease aircraft into our operating fleet?
No, leasing out. You have a large fleet you lease out to other operators.
We do. We've been a long time lessor from Ed, who's still in the room, from his time at the company, really starting that business. It's something we plan to continue on a go-forward basis. We have some very important relationships there with operators, really partners of ours around the world, from India to Mexico, Spain, and a number of other countries over time. We like the combination of leasing and operating because we think it allows us to maximize the utilization of our fleet. If there's not an opportunity to operate the asset for our own end customer, we can put it to work leasing it out, particularly in areas of the world where either we're not allowed to operate from a regulatory standpoint, we're blocked, or where it just doesn't make sense. And I would include Mexico. We are blocked from operating in Mexico on the one hand, but on the other hand, there are already 3 large, well-established helicopter operators in Mexico. There does not need to be a 4th, but we can monetize the demand coming out of that country by partnering with one of those operators and leasing them the equipment. And we've done that actually by introducing the 139s into an operator in Mexico who had never operated that model before, and so we provided them with the technical support and the maintenance plans and design to get them into that business. And so we think those partnerships and leasing will continue to be an important part of the business going forward.
Any more questions?
So in terms of rationalising your fleet, I can imagine that there's going to be some types coming out on the market. Would you be able to give us an indication for roughly how many and what type you are looking at?
I think how many, that number will change depending upon your time horizon. We do think that there's some work to do to rationalize the fleet over time. Certainly, if you look at some models, the combined company will have a lot of S-76s, about 60 S-76s. That number will probably contract over time. Those aircraft need to be repurposed, really from an offshore mission to a different in-market mission. There are still some Bell 412s or Bell 212s in the combined fleet. Those aircraft will either be leased or sold, as there's really not much of a place in the operational outlook for the combined company. So I think those groups, the S-76 and the legacy Bell mediums, are 2 of the most likely candidates for near-term rationalization.
Chris, Joe Hawk, great presentation. I'm a fan of what you guys have done, and that may be borne out in my subsequent presentation. I'm just curious if you could talk at all about, within that $35 million of synergies that you've identified, how much of it relates to sort of MRO
Thank you, first of all, and I would say directionally of the 35 million that we've identified, the fleet savings are the smallest contributor to that number, but also where we see the most upside over and above the 35 million that we've announced. But if I think about the three buckets that we identified, most of the 35 million is coming from the elimination of the redundant corporate expenses. The next largest contributor are the operational efficiencies that we plan to realize in the U.S. Gulf of Mexico. And the third, and as I said, smallest contributor to the 35 million are the fleet savings. But we do believe there's additional upside there once we're integrated.
Okay, any more questions? When did you start talking to Bristow?
Oh, that's a long and storied history. We will file an S4 with the SEC that will have a lot of the history, but I would note just, again, at a high level and directionally, that the two companies have been talking for years, many years. And there's been a strong belief for a while that this was really the right combination, the best combination. For various reasons, it didn't work out in prior iterations, but the timing was right here. A new set of stakeholders at Bristow, a much stronger financial picture at Bristow coming out of the Chapter 11, and really the right time to put together a merger that we believe has made sense for a very long time.
And did you consider merging the names into Era?
We thought about engaging a consultant and paying them like $3 million to come up with a word that's never existed, but we decided to stay with Bristow.
Okay, brilliant. And on that note, thank you